Welcome back, financial friends, to Am I Catching a Falling Knife, the podcast where we sift through the market's tumble to find potential opportunities. I'm your host, Dave, and today we're taking a deep dive into the Mosaic Company, ticker symbol MOS. This one has been on quite the slide recently, shedding a notable 16.81% over just the last few days. So, is MOS a value opportunity waiting to be scooped up, or are we looking at a truly dangerous falling knife? Let's find out. The big story, the single most dominant market narrative driving this price action is their recent Q2 2025 earnings report. Simply put, Mosaic missed Wall Street's expectations for both non-GAAP EPS and revenue. This is a crucial point because it happened even after some analysts had upgraded the stock and increased their price targets in the weeks leading up to the report. It's a classic case of market sentiment getting ahead of the actual numbers. So, who is the Mosaic Company, or MOS? Well, they're a global powerhouse in the agriculture industry, one of the leading producers and marketers of concentrated phosphate and potash crop nutrients. Think of them as fundamental to helping farmers worldwide grow their crops. They own and operate massive phosphate rock mines in places like Florida, Brazil, and Peru, and potash mines in Saskatchewan, New Mexico, and Brazil. They also have a huge fertilizer distribution network, especially strong in Brazil. Their revenue is fairly balanced, with phosphate and their Mosaic Fertilizantes business each making up about 38.4% of sales and potash bringing in the remaining 23.2%. Geographically, Brazil and the United States are their biggest markets, each contributing over a third of their revenue. Financially, they pulled in $11.06 billion in revenue last year, with $212.5 million in free cash flow, though they do carry about $4.37 billion in total debt. Their gross margin over the trailing 12 months is around 14.47%, which is important when we talk about how earnings get impacted. Now, let's break down how this Q2 miss likely impacts Mosaic's future earnings. The fact that they missed on both revenue and EPS in Q2 2025 tells us that the underlying market conditions and their fundamental performance were weaker than analysts had anticipated. And here's the kicker. Because Mosaic's core business is in cyclical agricultural nutrients, it's highly probable that the same headwinds that caused that Q2 miss, things like lower commodity prices or reduced demand, are likely to stick around and affect their upcoming quarterly earnings as well. This dominant market narrative means Wall Street is reevaluating Mosaic's near-term outlook, which almost certainly means analysts will be revising their earnings estimates downwards for the next quarter to reflect these new lower expectations. While we don't have the exact percentage of the Q2 miss, historical data suggests that when a company misses on both revenue and EPS, it often implies an earnings shortfall of somewhere in the range of 5% to 10% compared to prior expectations. So, taking all that into account and considering that Mosaic's operating leverage, meaning how their gross margin of 14.47% can amplify changes in revenue into larger changes in earnings, we're estimating that their upcoming quarterly earnings will likely be negatively impacted by approximately 6%, relative to prior market expectations. Our confidence in this estimate is moderate as the initial miss wasn't quantified, and the exact short-term operating leverage can be tricky to pinpoint, but we feel pretty good about that 6% mark, with the potential impact ranging from a 3% to 9% decline. So, with that significant hit to future earnings in mind, what's MOS really worth? To figure out what this stock is truly worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. This is where we project future cash flows and discount them back to today. For our assumptions, we're using an EPS growth rate of about 13.3% for the next 5 years, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Our base case DCF model gives us a value of around $67.51. But then, when we apply the impact of our narrative, that estimated 6% hit to future earnings, our narrative-adjusted DCF value comes in at approximately $61.43. Now, the second method is a bit simpler, a PEG-based valuation. PEG stands for price earnings to growth, and it's a quick way to see if a stock's price is reasonable relative to its earnings. Based on that, Mosaic's PEG-based fair value is around $58.72. Considering the current price is about $30.93, both these valuation models suggest a significant potential upside if the company can navigate these headwinds. For those of you wondering where you might consider stepping in, if you will, my custom buy levels are set at $28, $24, and $20. These are just potential entry points to consider, especially if the stock continues to experience volatility. So, to wrap up our look at MOS, remember, these custom buy levels are just points of consideration, not guarantees. As always, this podcast is for informational and entertainment purposes only and is absolutely not financial advice. Investing involves risks, and you should always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Thanks for tuning in, and I'll catch you on the next episode of Am I Catching a Falling Knife?